Good day everyone, thank you for joining me. I'm Tamara Kukshinovich and I'm going to take you through Liberty 2 Degrees EIA. In February, Liberty 2 Degrees released year-end results. The highlights were as follows. Revenue fell 12.1% to 878.8 million rand. Net rental income fell 45.6% to 377.2 million rand. Vacancies increased from 4.1% to 5.9%, and that was mainly driven by the office sector. The weighted average lease escalation fell from 7.4% to 7.2%, and tenant retention reduced from 84.7% to 84.2%. Distributable earnings fell 46.5% to 293.7 million rand. On a per share basis, distribution fell from 60.43 cents to 32.33 cents. The net asset value reduced 21.2% to 760 cents per share, which was mainly driven by the fall in property valuations. Term borrowings increased 5.5% to 1.7 billion rand. The loan-to-value ratio increased from 16.1% to 20.5%. And the interest cover ratio deteriorated from 4.7 times to 3.9 times. The market's reaction was neutral after the announcement, with the share price closing at 489 cents per share on the day, representing a 0.8% incline in the share price. Since the group released its interim results in July 2020, it underperformed the SAPI index with a negative return of 5.9%, while the index had returned 10%. Year to date, the share price has outperformed the SAPI index with a return of 12.9%, while the SAPI returned 3.1%. On a price to book basis, the group is currently trading at an 8.6% discount to its peers and a 16.8% discount to its historical average. The group's balance sheet is strong relative to other real estate companies, as seen in the very comfortable loan-to-value ratio of 20.5%, which is well below its covenant of 40%. Although the interest cover ratio deteriorated from 4.9 times, it is reasonable at 3.9 times and above its covenant of 1.9 times. This has come under pressure because of its high exposure to entertainment, food and beverage, as well as the social component offered by super-regional malls. Additionally, Liberty 2 Degrees also has exposure to hospitality. These sectors were hardest hit by the pandemic. That being said, we feel the group is well positioned given the effects of the pandemic on the real estate sector. Despite the slight increase in debt, the near-term cash requirements remain relatively low, with a 27% of term debt maturing in 2021. The group has enough liquidity to meet commitments when they fall due. Liberty's discount to its 5-year historical average has improved since the release of its interim results. As a result, we believe that the share is fairly valued at current levels, and we retain a neutral view on the counter. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. Additionally, the report on Liberty 2 Degrees can be found on the PSG online trading platform. But before we end off, please take note of the following disclaimer. Thank you.